A 30% fall in house prices. That was Bernard Hickey of interest.co.nz's bold call 18 months ago. Homeowners will probably be pleased or relieved to hear he's revised that fall down to 15%. To talk about the revision and about how exactly we can know where house prices are at, I'm joined now by Bernard and Alistair Helm of realestate.co.nz. Good morning to you both. Bernard, firstly, the drop in a little more benign outlook to 15% fall. Why did you bring it down?
Well, we've seen banks continue to lend into this market quite heavily over the last couple of months, and many rental investors have returned, partly because other investment choices, the stock market and banks, have been so poor over the last 6 to 12 months. Finance companies too. So people are saying, well, do I accept 3% in the bank, or do I try and find myself a rental property? And the only thing I know that's worked for me over the last decade is rental property, so they've gone straight back in there. I think that we're making the same mistakes all over again, and the market remains overvalued, but it's clear that the market has stabilised and that we could still see some further falls a little bit, but not the sort of dramatic falls that we were seeing last year, and that we seem to be nearing the point of bottoming out.
And do you think that 15% fall from top to bottom will be over quite a few years now?
That's right. I think we saw the peak in December 2007. I think we might not see the trough until around 2012, and then it will slowly grind its way back up. We may not actually see those 2007 levels again until 2016 or so. So for those people who bought in 2006 expecting capital gains, they could go for a decade without those capital gains.
And in terms of the outlook for interest rates, we've had some interesting comments from the Reserve Bank. They've come out saying that the fixed rates are perhaps okay, floating rates not so good.
That's right. The Reserve Bank's looked at the margins the banks are charging and said that the fixed rates, which most people have, they are okay at the moment. But the floating rates haven't fallen as far as the Reserve Bank thought they might. Now, it's jawboning the banks. It says, come on, get those rates down. The banks, frankly, are unlikely to move that far. They've decided to, for their own reasons, to, in a way, subsidise the fixed rates, which most people are on, with relatively high floating rates. And we'll see now whether or not the banks act. I don't think they will.
Alistair, working out exactly where house prices are at now is extremely confusing, isn't it? That we have the QV prices, we have the Real Estate Institute prices, we have Barfoot and Thompson, Harcourts, they're all streaming out. What do you think we should be relying on at the moment?
Well, each has the same raw data, sales statistics of what is sold. It's only a question of which segment they're looking at. Barfoot and Thompson are looking at their sales in Auckland. Harcourt's are looking nationally, but they're only one part of the whole market. The Real Estate Institute reports sales figures. They're the most timely. QV data is based on exactly the same statistics, but it comes out later because they wait for the conditional sales to be completed and put through the solicitors. So it's all the same data, and if you look at the numbers, there's actually not much difference. There may be, the Institute may be saying 4% down off the peak, and QV may be saying 6%, but that's more a function of the way it's at in the tail of the movement at the moment. And most of it is seeing that we've in some ways seen a fairly significant fall from peak, maybe 8 or 10%. But the current figures are about 6% off peak, and I'm talking about peak 18, 20 months ago.
Bernard, what do you rely on?
I look at them both. They've all got their merits, and the REINZ figures are the most fresh, if you like. They come out and you know that they're for the most recent month. The QV numbers, some would say that they are a little more reliable over the longer run in that they compare different things and perhaps remove some of the risks of skewing in one way or the other. I think they're both worth looking at and give you an idea of what's happening in the market. And one of the reasons I've revised my forecast from down 30% to down 15% is that both sets of figures now are clearly showing the market beginning to pull out of that death dive that it was in last year, which many people will be pretty happy with.
Yes, exactly. Alistair, what are your feelings about how low prices will go, or have they gone as much down as you expect?
Well, I was looking at the figures to see what it says, and I think the important one is most of them are reporting year on year, but I think the important thing, as Bernard picked up on it, is you look at where the peak was, and the peak was around October, November of 2007, and the biggest fall from that at any one point in time was actually the Real Estate Institute figures. Now, they usually report a median, which is a nice way of smoothing out some of these issues, but actually you can look at their statistics on average, for example, and that fell by 11% in January from its peak. Now, that's then come back to 6% down. So I think we're all seeing a degree of, it's kind of reached a really low point. It's beginning to come back. Now, the issue about property prices is it's a very, very inexact science trying to work out where it's going to go. You're much better trying to work out where share markets or investment minerals are going to go than you are with property, because it's not driven by pure financial. It's driven by emotional, psychological, environmental issues as much as anything. Everything affects property because it's so much part of our lives. And I think, I guess, I concede with Bernard that there was a time when 30% almost felt like it could be. And we've seen, 30% in the US and 22% in the UK. But I think New Zealand has a different issue around property that has not seen as dramatic a fall and won't continue to see those falls in the future.
The difference here is that our banks are strong and are still lending. In the UK and the US, their banks almost collapsed. And people stopped lending, and they still have stopped lending, and the banks were foreclosing on people. Here in New Zealand, the banks are strong. We can thank our stars. We have these strong Australian banks still leaning into the market. That's the reason why we haven't seen the catastrophic numbers we saw in the US and the UK.
OK, thanks very much there, Bernard Hickey there, and Alistair Helm. Stay with us when we come back on the program. The reliance on housing as an investment, is it a healthy choice? And why Telstra Clear has